making no noise.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker and registered investment advisor before taking any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. NimbusStockWorld.com. CSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, and registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the SEC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying a guarantee of any profit. What is wrong with this? As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified day. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter.
What the heck? All right, anyway, I don't know what's wrong with this thing. It used to work fine. That makes no sense. I just reloaded the whole system, too. All right, nothing we can do about it right now. So, hello. All right, let's see. What were we looking at? Let's see how the market's looking. Look at that nice move in natural gas. That was very good. I cashed it out. Almost right. I missed it by a penny, but it was up 6,000 for the day, so I was like, screw that. That's plenty. It's kind of ridiculous, right? So we were playing, we love playing natural gas off the $3 line. It went below the $3 line, but so what? That still seems to be generally a good place to hold. All right, yeah, that's the thing that happens a lot. People take these things way too literally. And of all things, I have a daughter, very, very clever, my little one, Jackie, yet she takes things literally a lot. And I keep working with her on it. It was like a fault of hers when she was young, though, that she would take everything very literally. And I noticed that it's sort of a personality trait people have, and it's nothing bad, but it's just something that, you have to think about it in yourself if you're doing it, because especially when you're listening to people like me and getting advice from people, taking notes or something, not everything is absolute. And just because somebody wrote something down or somebody said something doesn't mean that's exactly what it is. So, for instance, if we say the S&P is going to top out at 2440, which we have said on multiple occasions, it doesn't mean that if it stops at, let me try to get a closer view. Okay, so in other words, if it goes over 2440, that doesn't mean it broke over. It's not literal, like if it doesn't stop exactly here, it's failing. Things overshoot and things undershoot and things come around to a place that you didn't think so. Like here, this is when I first said it. I said if the S&P doesn't break 2440. Now it happened to work. See, that's the problem. Sometimes I hit it on the nail. I hit it right on the nose, and everybody thinks, oh, well, that's what it should be next time. But it's just a coincidence that I said 2440 here, and it failed right at 2440. That was just luck. I mean, it's a 5% rule. But again, it's luck. It's not a thing. It's not like the 5% rule is programmed into somebody's computer. It's just that the 5% rule is what we see as an aggregate working well, and it works best when there are computers around. So I'm not going to get into that again. I mean, someone should archive like some of these things I say, because I don't want to tell the story of the 5% rule all the time. But the gist of the 5% rule is I developed it because my father and I used to consult with the banks to build the original trading systems back in the 80s, and in the 80s and the early and the 90s. And so, my dad wrote a lot of these original programs for trading. I wasn't the programmer. I was the guy who could speak financial and speak programmer. So I could speak to my dad, and I could speak to the bankers, and I would sit there in between them and say, okay, what they're trying to tell you is this. And I'd be like, oh, what he's saying is impossible is this. You had to translate, basically. But anyway, for those systems, what I noticed in going to all these different banks and building all these systems, they all wanted to have a unique system that would give them the edge, that would do things that other people aren't seeing, and blah, blah, blah. And it's all bullshit, because how many different ways can you really look at the market, right? So, we're confidential. We can't talk about anything that we're discussing with these people. But what I noticed, though, is that by the time these guys talk to the programmers and they have a committee meeting and then they talk about changes and then they have rules, you have to have rules. But what are rules? People make rules up and they're not arbitrary. They tend to, so the rules that people make for selling and buying and the points of inflection are generally tend to work out in the parameters of what I call the 5% rule. And that is that things tend to move in 5% increments. One of the reasons things move in 5% increments is there's two factors here. First factor is people always round things off in their heads. Like people like round numbers. People say at 1800 we do this, or at the next 20, at the next 00 line we'll do that. People don't usually say at when it hits 013, that's when we're going to change it. People don't think that way. So that's number one that causes a lot of fives, is because everybody rounds off to zeros. And the average of people rounding off to zeros tends to be 5. And 10, but the 5% rule covers anything in that range. And the other thing is that there's no such thing as an actual random number. People think there are random numbers, but there aren't random numbers. The computer runs a program that creates what is basically a random number. It seems random, but to the computer it's not random at all. If you start, this number, if you start the sequence at this time, the computer will come up with the same random number every single time. It's not random. The computer runs a program, picks a number that's based on several factors that make it seem random, but it's not really a random number. Now, that doesn't matter for most things. It doesn't make a difference, but it does make a difference to something like if you're trying to use, by the time you use 20 or 30 different random number sequences in the same program to time certain things or to look at certain factors, all of a sudden they start coalescing also, and they become completely non-random. And that's what this is. So in other words, what we're saying is you're going to get moves that are roughly in the 5% range. Now, that includes 2.5%, that includes 1.25%, and that includes 5% and 10%. And 20% for that matter. So it bases on a 5. It's called the 5% rule, but it counts on all those things. And that just means that a buying sequence is going to run about 5% before it starts getting exhausted. But the bigger something is, the more volume, the more randomness, the more people trading, the smaller those increments get. So in other words, you'll have a lot of significance at 5% almost no matter what it is, even in very light volume things. But when you get to heavier volume, like an index, then 2.5% is going to be just as heavy as a 5% line in something else. And even 1.25% in an index starts to matter a whole hell of a lot. So that's where the 5% rule came from. And the reason it works so fantastically today, because it never used to work this well. I made up this rule like 20-something years ago. But the reason it works so well today is because so much trading, probably 80% of all trading, is done by computers now. And so it's not that we know exactly how each program is written, but it's that we know how the average program is written, and that's even better than knowing. It's just like a moving average. It's just like knowing the behavior of computers and crowds. So just so you know when we talk about it. Now, meanwhile, let's keep in mind then, the 5% rule is something I made up. But you know what? The Laffer curve is something Laffer made up. Okay, it's all bullshit. It's just the best guess to extrapolate something. You know, if you have a mathematical theorem, that's a fact when somebody proves it. But you know, this is not going to get proven. It's just something I made up that's a good rule to follow. So, therefore, when I say something's going to go to 2440, it's based on my best guess of something. So if it goes to 2450, I'm not surprised. If it stops at 2430, I'm not surprised. It doesn't make it invalid. It's a concept of a move, not an exact number. Because I know a lot of you guys keep asking about, oh, what exact number? Where are we going? It's like, no, this is just a rough thing. And in fact, for the 5% rule, there's an art to it because you have to decide where the consolidation point was it's going to start from. So in other words, if you look here, we had a run from 2410 to 2435. That's 25 points, right? That means your pullback on a 25-point run is going to be 20% of the run. That's 5 points. Well, there's a 5-point pullback. Then it goes back and back and back. But notice that 5-point pullback is working. It's consolidating on the 5-point pullback. So you think there's going to be a breakout, but instead it goes below, but only very briefly, quickly reverses, then goes back up, doesn't really break out, and then crashes. And again, and I'm the first guy I'll tell you, TA is complete bullshit. But you can't just use TA. So in a vacuum, that's what you expect to happen. This kind of consolidation is bullish. But then something happened here today, that day anyway, that spooked the market and everything. It's a couple of days ago, and spooked the market and everything fell down. Then it tried to rebuild, and something else happened to spook the market, and everything started going down again. That was yesterday. Okay, so meanwhile, though, you don't know anything because it's just an hourly chart. That doesn't really predict behavior. You have to be realistic about that also. Your sample size is super small if you have an hourly chart. You need a better sample. A better sample is going to be the day chart. And on the day chart, we have these lines. And, you know what? I forgot what the S&P number is. But I know 1850 is our baseline on the S&P. 1850, that was a proven good number. So then we multiply that times 1.2. That didn't work at all. Okay, that was addition. 1850 times 1.2 is 2220. So we know 2220, very significant line on the S&P. So now, even though you say, oh, well, 2200 is a nice round number, no. 2220 is a number we've been using for a long time for the S&P. That's a 20% line. That means all moves up from 2220 should be based off of 2220. All right, so 2220 times 1.5%. What? Oh, idiot. 2220 times 1.05%. is 2331. So then you want to see 2331 is 5%, and 2220 times 0.1, 2442. All right, so I say 2440 because it's a rounded number, but the reality is 2442 is the actual number predicted by the 5% rule. Okay, we just took liberties. And what is that? That's like the 30% line from 1850. 1850 times 1.3 is 2405, in fact. It's a little different because if you start from 2220, it's a different number. So 24, I'm sorry, that's wrong. The 30% line is that. My mistake, sorry. So you have to be aware of that. The 30% line is 2405. So that's a solid move. And I think we have that on our big chart. Let's see. John Luke got it up today, so let's see. Did he write it? Yeah, see, 2400 is really 2405. That's the 30% line on the big chart. So these are the lines, in a default, you want to look back and say, oh, what significant line are we at? And you can see how well that works out. Now, don't forget, this is the line we predicted. These lines are from 2014. That's the last time we've updated our lines. We need to update them now. But we haven't changed these lines since 2014, and they still work. That's how good this stuff is. And again, though, TA, complete bullshit. The only thing it's good for is what I'm doing here. Is to just say this is the range you're going to be in because this is how computers trade when they get into a range. That's what I do know. But it's got nothing to do with technical analysis. It's got something to do with how computers work. All right, so see if we have any questions to start with. I asked this question, I'm just curious if you remember the max drawdown of the LTP. Okay, well, first of all, the LTP is structured as such that it's not going to lose much money because we roll into it so slowly. We would only add a couple of positions a month to the LTP. So it's a $500,000 portfolio. With a $500,000, we have $1 million in buying power because we assume ordinary margin. We don't assume portfolio margin. So the $500,000, we have $1 million in buying power. That means our allocation blocks we divide that by 20. So we have $50,000 allocation blocks. When we initiate a position, we generally try to initiate a 1/4 allocation block position. So we're only going to go in with $12,500 blocks into each position, and we're only going to do a couple of months. So unless you're incredibly unlucky, and we weren't, you're not going to have much of a drawdown building a long-term portfolio. Unfortunately, though, it's also incredibly tedious to build a long-term portfolio because it's like watching paint dry. But it should be. That's what large-scale investing should be like. Now, not only that, though, but the long-term portfolio, if you count the hedging, it's almost impossible for it to have a big drawdown. Now, on the other hand, though, the options opportunity portfolio, and this is my fault. When I first set it up, Seeking Alpha was telling me, people want, they don't they don't want a boring portfolio. You've got to trade it more actively and blah, blah, blah. So I came up with a lot of short-term trades, earning trades, so on and so forth for them in the beginning. And the portfolio, we hit a bad spot. It was August of 2015, and something happened. I guess the market must have tanked. I don't really remember anymore. Something bad happened right after we started it, though. This. Yeah, we started that portfolio August 8th, and we started it, unfortunately, with a bunch of positions because I wanted to get it going, And the market did this right after, and we certainly didn't have any hedges built up or anything to cover it. So the portfolio was down like 40% around here. And people were freaking out completely. It was a brand new portfolio. It was down 40%. And you know me, I'm like, what we do here is we take all of our cash and we buy, and we double down on things and we buy more stuff and so we with barely any buying power left, we just filled up the portfolio with everything that seemed to be like good and cheap on sale, and obviously we had we had a small recovery, then screaming again, and then a very nice recovery. And then by this time, we were ready because we had the hedges. But when we started here, we didn't have time to even put in hedges. I was not expecting a collapse of that nature at the time. The long-term portfolio was fine. I mean, it probably lost 10, 15%, but it was fine because the short-term portfolio protected it. In fact, the short-term portfolio here and here made a fortune. But the options opportunity portfolio really didn't even have a hedge. And all these brand new positions we had just put on to start the options opportunity portfolio, they crashed literally the same week, and it was a complete disaster. Like every position in it was down. That was bad. But Since then, fantastic recovery. So all the people who joined a week later, when we were down to like $60,000, about $60,000, those people did fantastic because now the portfolio is $300,000. But it started off very, very badly. So, again, I would not do that again. See, I was encouraged to do more aggressive positions. The more aggressive positions had a massive failure. And I said, screw that. From now on, I'm only doing portfolios, especially teaching portfolios to teach good, safe techniques, not teaching hot dog techniques. Once upon a time, we had a $25,000 portfolio. We got that up to $100,000 in 1 year. That was like 5-6 years ago. But again, the market was, of course, on steroids, so it wasn't that hard to do. In fact, that was my point when we did it. Is I said, hey, if we take let's see if we can take a $25,000 portfolio and double it. That was my initial thing. We doubled it in like not even 6 months, and so I said, let's try to double it again by the end of the year, and we did. We hit $100,000. But that was when they were stimulating the market, and everything was so dirt cheap from the crash. It was just, you could see what was happening, and so I said, I bet anybody can double their money in this market. It turns out you could. Anyway, point being that there's no historical drawdown. It's very arbitrary when you start a portfolio how good it's going to do. At this point here, when the options opportunity portfolio crashed, the long-term portfolio was almost a year and a half old. So we were very well hedged and no problems. In fact, the article I just pointed to today was one of our cash outs. We've cashed out the long-term portfolio on several occasions, and May of 2015 was one of them. When the market went this high, and again, because of the 5% rule, telling us that this was too high, we cashed out. And nothing happened, and nothing happened, and nothing happened, and then the market crashed, and that was great, because for the long-term portfolio, we just started buying like crazy. And then it went up and up and up. I think we cashed out again. We did. We cashed out again here. It was like, because again, we got to the point here where the 5% rule said we were too toppy, too early. And so we cashed out again. Then we had this phenomenal crash. Then we started buying, and then it's been great ever since. Now I'm basically back to thinking things are too toppy, though. But, it's not a hedge fund, these portfolios. The drawdown is not a thing, but I am practicing the kind of techniques you'd want to use in a hedge fund. And again, other than that mistake I made with the options opportunity portfolio at the beginning, I'm trying to practice the techniques that you should use in a hedge fund to not be that, to minimize the volatility while still, capturing some of the upside. I hope that helped. Other QS. I don't know what that means. Apple getting weak, what price levels would be, I see, another question. Apple getting weak, what price levels would be good to sell 2019 puts? I don't know if I'd call what Apple's doing weak. And again, getting back to, all right, so getting back to the 5% rule, this is a good chance to take a look. So what do we expect Apple to do? All right, step number 1, identify the bottom. All right, so clearly 80 is the bottom for Apple. Now we go to Yahoo, not that Yahoo, that Yahoo. And we go to Apple. We need a bigger chart. Okay, because 2 years is bullshit. You're not going to get anything off of 2 years. That's not Apple. All right. So my theory is 80, and it's supported by this. We're in the 80s here. Okay. Although, knowing that they had a 7-for-1 split, really 100 was 700. We know that, right? So when they were 700, they were 100. And 80 was a random number. 700, 600, 56. So 60, no, 56, yeah, 56. So 56 is here. Okay, and 100 up here. But I think 80, in my mind, is the midpoint for Apple. I think Apple is obeying that. It wasn't, like I said, 80 was 560, it wasn't really a proven out thing in the old numbers, but I'm pretty sure that 80 was the right base. I don't know why it's just stuck in my head. So I'm going to say it is, even though I'm not sure. Let's start 5-year chart and see if it's better. Yeah, I mean, you can see the case to 80 over here, because you have this one over here, and you have that, and you have this. So, and then even on the dip, it comes in that range. All right, and also the other thing is that you have, now, if you have 80, you assume that 120, 50% plus 80, is going to be significant too, and it is. That backs up your concept that 80 would be the right place. But that's the thing about the 5% rule. There's a certain amount of art to it, because you have to look at it and say, where are we basing? Where are we forming good support resistance channels? Because that's what I've got to start using. So in Apple, I would say they've proven themselves that they can go over 120. Okay? And again, and this is the other key thing in the 5% rule, you got to learn to throw out these spikes. This meaningless. Anything goes up and down the same day. Who cares? Okay? What matters is where it's ranging, where it's averaging. So the range up here, this is the 125 line high. This is the 120 line. Here's 120 and it stops. Here's 120 and it stops. And again, 117 is not 120. Nothing is absolute. Okay? It's like an air rejection over here. And over here, see how it breaks up over 120 and then rockets? Those are all good arguing points to say 120 is the correct place. So, meanwhile, what you would say then is you have good consolidation below 120, you have a breakout over 120, and no pullback until you get to 160. Okay? Now, if it's 80 and 120, that means we're moving in 20. So 120, 140 should be significant, and 160 should be significant. Okay? It matters what you're doing off your base more so than, it's 120. You don't say 10% times 120. It starts getting arbitrary. It's more important what's happening at 80. So 50% plus 80 is 120. And then 25% more is 140, 75%. And obviously 100% of 80 is 160. And frankly, if I was going to say, does double 180 cause a rejection, because that's the 100% line, certainly on the first try, you expect it to be rejected at 100% gain? Yes. So again, now we're back to the argument that 80 is the right place. So therefore, if you're rejected at 160 and it's bullish, then first of all, from the 80 line, you're not going to see anything more than a weak retrace. 80 to 160 is 80, and then it's an 80-point move. 16 points below 80 is 144. I'm sorry, 16 points below 1. No, it isn't. Yes, it is. 16 points below is a weak retrace. 32 points is it's not even that. It's the 80-point move. It's 20% of the 80-point move from 80. You don't go from 0. You go from where it based at. So 80 to 160 is an 80-point move. 20% of 80 is 16. That's why I get confused, because it's exactly the same as 160. So 20% retrace of this goes to 144. That's what the 5% rule tells you. We could have had a discussion 2 years ago, and we would have been talking about where it would have gotten rejected. That's why the 5% rule is fantastic, though. So you say, if it's bullish on a run all the way to 160, where is it going to get rejected to? Well, if we're still bullish, it'll get rejected to 144, but hold it. Because that's a 20% pullback of the run, a weak retracement. It would consolidate here, but not for long, and it should come back and retest it, and then the next dip will be lower. Now, that's interesting, because as I think about that in my mind, I'm also looking at this rising 200-day moving average, and that's going to be supportive. So if we hold this line here, this line will continue to rise. We'll test up here again. And by the time we come back down and test it again, this line will have risen to here, right where we're going to test it again. And then it's going to have the strength due to the pressure, the upward pressure of the 200-day moving average. You're going to have, think of that like a wave coming in, right? Pushing. You know, when it's up, it's a bullish wave. When it's down, if you get on the wrong side of it, it's a downward wave pushing. But it's pushing the front of the wave. So things are going to tend to go that way. So if we're in a bullish channel, if we're going to break over 100% gain on Apple, then this should hold. If this does not hold, then you're into a strong retrace, 16 more points down. So 144 minus 16 is 138, 128. Now, interestingly, 128 happens to be the 200-day moving average at this exact point. It's 128.20. Okay? The 5% rule is like magic. It's just like, oh, well, there's the exact number we thought it would be. So, unless something is tragically wrong with Apple, and interestingly, look, see that 128 line? That is the strong retrace from a double, and it was resistance on the way up. We pulled back to test practically 80, and then we came back to 120, the 50% mark, little rejection at there. Now it's ready to rock and roll, but not quite to go over the double yet. Now it's going to consolidate and then fly higher, unless something goes wrong. So the TA, you know, the technical stuff is nice, but then you have to think about what's actually happening in the company. Did anything change? All right? Not only that, though, we actually have to factor in the dollar at some point, but we won't, you know, that will, you know, consider to be neutral. But if there's drastic changes in the dollar, that then moves the lines as well. So what was the question? Whoa. Whoa, whoa, whoa. How did that even happen? Ooh, it popped out. Go back where you belong. Okay. All right. So, learner. Wait. No, that's not it. Apple. All right, so what price level would be good to sell puts? So, you may not get, there's the answer. Okay. So, you may not get a better price than this to sell puts. But I would cross my fingers and hope that Apple gets dragged down by the S&P. But then here, 128. This is a line I think even on a pretty bad pullback that's probably going to hold up. And that's the answer from the 5% rule. What's your outlook on IWM or TZA for June? You had suggested TZA, blah, blah, blah. Spread. Well, for June, June's over, dude. Let's see. Look at TZA, because IWM's not even much of a play. And TZA, well, I'm sorry, you really do have to chart IWM, though, to play TZA. Because otherwise you don't know what you're talking about. And frankly, I don't like using IWM. I want to use the Russell. But let's just assume that they're right, that it's in line. Because I just want to see that the thing's right. Now, in the Russell, where is it? Well, the Russell has blown through our numbers, but the Russell was at 1,200, and we're at 14 now, so you're looking at about, 20%, 1,200 times 1.25, 1,500, right. That's too high. So 1,200 times 1.2 is 1440. All right, so 1440 is the 20% line, and the 15% line, 1,200 times 1.15 is 1,380. So it's 1,380 to, what did I just say, 1,440? Okay, so 1,380 to 1,440 is the range that we're in for the Russell. All right, and now that we've calculated that based on numbers alone, okay, TA is bullshit. This is numbers. This is just math working with computers. So now that we've seen that, now let's go to the futures chart and see if 1,380 and 1,440 are things you look at on the Russell. All right, so here's the chart, and you can see right here, like 1,380 is right about, well, let's see, I guess that's 1,375. So right in the middle of this lane is 1,380. So clearly we're consolidating around there. 1,440 is where we got rejected. So that is basically your range. But it seems to be not really holding 1380 yet. So it does not look like, see, if it's going to start making a move higher, you expect 1380 to be more of a support. If it keeps going below it, that means it's not really setting itself up as strong support. Remember, we based off 12. We're based off 1200, and you can see here how once it gets over 12, see how 12 becomes strong support. And just because, and again, not literally, because just because it fails doesn't mean it's strong support. It failed and came right back, even though that coming right back took 2 or 3 weeks. But it failed and came back, so in the retrospect of looking at it on the big picture, it was still strong support. It just, for whatever reason, something happened here that caused people to freak out. But in reality, though, it turned out it was such strong such strong support that it basically took all this time that it was below and put all that energy back into going way the frick over. Right after once it got back over 12, it shot out like a cannon. All right, that's what you expect to see at the support line of something that's bouncy. So now you got to go up to 1380, and you expect to see the same kind of support, and you're not seeing it yet. Oh, I'm sorry. And by the way, the 10% line was 1320. Look how that became support immediately. See what happened here? 1320, it had a very, very minor pullback to 1320, and then it shot right back up and to the next support line, to the next 5% after that, and it went up, and then the next 5% it just failed, so it drifted back into this zone. But still, on the whole, a very bullish overall pattern. If you go out to the weeklies, you can see that, right? It's basically doing what it did over here. See what it did here? Came up, came down, came up, went across, and then starts grinding back up again. So, this thing could be heading to the moon. It's hard to say, but wouldn't bet against it. So what was the question, though? The question was, what do we see it doing? Now, my outlook is not based just on the fact that the chart now, it's got a bullish chart. It has a very easy time going higher, but I see just too many different things that can go wrong to assume the Russell is going to just keep going up. All right? So, again, I don't play TZA because I think TZA is a great thing to buy. I play TZA because it's a great hedge. But a great hedge, you had a TZA 630.17 spread. We certainly don't have it anymore. That would be an old thing. 16.50. Oh, I'm sorry. Yeah, we did a quickie one. I forgot. I'm terribly sorry about that. We did do a TZA spread. I forgot we did that little mini one like last week or this. I don't remember when I did it, but yeah, we were just talking about like making some quick money. So where are we? We're right where we're supposed to be. So the question is that I'm sorry, I misinterpreted the whole thing. You had no need for that entire discussion. Was it 16.50? It's in the money then, isn't it? It's not 6:30. See, this is what I'm worried about. You're saying 6:30. It's this week. It expires tomorrow. And it should theoretically expire in the money. I don't see any big recovery coming today or tomorrow. So I think that my trade was on track. I don't remember what day it was. If you have the 6:30 ones, I'd be a little bit worried about that, though, because that's 2 more weeks and it can screw you. The point was that it was just a 1-week play, and that's what I liked about it, was it was a real quickie thing. Let's see, RB. Backwardation makes sense if sentiment thinks after July 4th demand drops. Also, the previous years had big dips. Yeah, if you look at the gasoline last year, it was a total disaster for people who went long into July 4th, like we're doing now. But look, conditions were interesting. Let's see. Okay, so this thing I think goes back to last July 4th. Yeah, look at this. So in June, everybody thinks everything's going great. It racks up to 160. And you're coming into this is actually right about where we are now in June. Then it like completely fell off the table. And then it recovered a tiny bit and then got much, much worse. and that's the July 4th holiday. Total disaster. I don't honestly remember why things fell apart there, but it's not different demand-wise. We're going to have just as bad demand and just as much disappointment. I was actually hoping we'd be back at 160 so we could short, but we were at 140, and I do think 140 is a little bit low right into the holiday. I think we should get a move up to at least 145 right now. And today we're at so we hit 144. I took mine off the table at 144. I'm sorry, I took my front months off the table at 144, but I was freakingly down over here. And so fortunately I added a bunch, as I said, I was going to roll, so when it was down here and I'm down like $10,000 on my contracts, I said, okay, well, if I want to stick with it, I don't want to stick with it in the front month contracts because they expire soon. So I wanted to move to the August contract. I moved to the August contract, but because it held the line at 141, I had no reason to close. And then luckily, all my contracts went up here, and then I got the hell out. I took that money. I'm still behind a couple of $1,000 on gasoline, and all I have left in my my August contracts. And I've only got only six. I only have 6 of those. But I'm so thrilled because I was down like over $10,000 earlier this morning. So it's fantastic. But at some point, I had a huge risk on the table. I had like 20 contracts basically down here before I cut back. But that's what the conviction plays are. And my conviction play is based not on any fundamentals. It's based on my faith in the people's ability to manipulate the market. Nothing to do with fundamentals at all. Fundamentally, this thing should be way lower. It's a dangerous, dangerous play. I certainly don't recommend it to most people, especially as a conviction play. As a stopping play, sure. KC seems range bound at 125, 127 last few days, plus 120. You still have KC? Yeah, I still have KC. I didn't buy the used because I want to get out of it every day. Let's see, KCU7. See, there's my RBs. That's my front month RBs. My RB, what are they? RB Q7. Yeah, so those guys are up about $2,500 now. What did you say? KCU, right? KCU7. 2. Oh, that's because it popped up early. Yeah, I had more. Didn't I? KCU, UV. Do I have more than one? KCU6. Nope, don't have those. Excuse me. All right, so the KCUs, I have 2. Wow. I thought I sold someone that hit 130. Very confused. Oh, maybe I have regular cases. Nope. All right, shows what I am. It's all a surprise to me. So apparently I have 2, and they're at 127, just a little bit below 128. So I have 2 right here. That is my position. And I'm perfectly happy with it as it is. So let's see if there's anything to play. Meanwhile, let's see if we can make some money. Although we already made huge money from gas and oil this morning. Not oil, sorry, it's just gas. Oil's not going anywhere so far. Oh, I do like oil here, 44.50. Not pretty tight stops, but 44.50 is a reasonable place to play. Dollar's going nicely, 97.50. Fantastic. Ooh, how much is that? Trade dollar. EX. What dollar do I have? I don't have DX. Up to you. Oh, there's the ones I have. All right, so the dollar I have 4 long at 96.68. So they're having a good day. But notice that the longer-term dollar is not as high. It takes a while to catch up because the curve has to come up because we had such a violent move up today that the long end of the curve hasn't come up yet. So I'm still down at 97.22, but the actual dollar, the front month dollar, is at 97.50. So if this holds up, if we hold 97.50 in the front month, the longer months will start to catch up, and that'll be like a very nice payoff. All right, but still, it's a couple $1,000 now, so I'm happy about that. All right, we were looking for something new to trade there, right? So, after a while, when you start using the 5% rule, you can eyeball things. So from 2440, you can see that's a weak bounce on the S&P. Okay, so that's failing. And if you want to do the math, well, let's do the math, Phil. All right. So this is only a 20-point drop. On a 20-point drop, what are you going to look for? You're going to look for it's a 4-point weak bounce, 24.44, and then 24.48. No, I'm sorry, 28. Sorry, 24.24. I can't stand all these big numbers. 24.24 would be the bounce because it's a 20-point drop. That means you're going to get a 4-point bounce this week, 24.24, and an 8-point bounce, 24.28. Look at that. Look at that line. Right. Oh, let's zoom in on that. Isn't this cute? There you go. 24.28. That's the 24.28 line predicted by the 5% rule. Okay, is that not awesome? It makes you realize how ridiculous all other TA is. And again, this is not TA, it's math. TA is complete crap. This is just math. This is the way computers work. When computers are buying and selling, they are going to coalesce at certain mechanical points. These are the mechanical points the computers will end up at. So what does it mean when this starts breaking? When it goes the other side, it means there's more buy programs than sell programs. When it's below it, when it stops here, it means that at this point there are more sell programs than buy programs. But all the buy and sell programs, and again, and it's not literally, not they're all at the same place, but the more buy and sell programs there are, the more the averages between them are going to work out. And they're going to hit the same inflection points. And those inflection points are then dictated by the 5% rule. And again, you don't know from day one. You don't know where they start. You have to observe where the bases are. And when you observe a base, a good well-established base, and once you have a well-established base, then the rest is all calculation, because that's what they do. Because the only way the computer knows what to do is some human at some point feeds it in a starting point and says, okay, from this line, you will then do the following. At 10% you do this, at 20% you do this, at 30% you do this. There's no people on Wall Street who say at 13.025% you will do this. That's not how people think. And that's why the 5% rule works. You have thousands and thousands of people feeding instructions to computers. And by the way, not directly. That's the other reason this works so well. It's not even that they're directly doing it because they are not the programmers. Hey, my dad would do really weird stuff when he was writing programs, and I'd be like, "What the hell is that?" And he's like, "Oh, it's a Fibonacci number. I like it." I'm like, "Oh, come on." But you can't do that when you're writing for a Wall Street guy. They're going to feed you instructions, and you're going to execute the instructions they feed you. And then even worse, because once the guy who designs the program, like my dad, would leave, then it's left to a bunch of junior programmers and analysts who don't know, they don't know crap. So all they're doing is just feeding in whatever the top office people send them and praying it doesn't mess up everything. So this is just what it becomes. It becomes nothing. You can spend $1 billion writing these programs, and they end up being nothing. They're barely useful. Well, I'm very skeptical about AI taking over trading. In fact, I actually think that it's going to be a disaster of biblical proportions as they turn more and more of this trading over to bots, as we saw in the flash crash a few years ago. But they didn't learn because instead of saying, "Wow, that's a really bad idea," they now have all these robo-advisors that basically just take your money and put it into indexes. And they're replacing all the brokers with computers and just saying, "Oh, the computer will take care of it. Don't worry. Just give us your money. We'll give you the computer." That is a horrifying idea. It's going to be fantastic for us one day because we're one of the only humans trading, and we'll be like, "Oh, okay." It's like, "Oh, you want to sell Macy's for $3? Okay, we'll take that. We'll buy the whole store." That's what happened in the Planet Crash. I mean, things were just coming to ridiculous prices, and there were people who made a fortune just buying the crap that the computers were dumping because they were prices no human being in their right mind would ever sell at. It's the problem with computers, though. They don't have a right mind. They don't even know what they're trading. They don't even understand. They don't know what IBM is. They don't know what Apple does. Apple is AAPL, and it's not even that. It's 010101001125. I mean, not two. It's all O's and ones. That's all it is. It's just a string of zeros and ones. You can insert any name you want there. All you have to do is tell it what the parameters are for trade. And if they get smarter, all they're going to do is mimic an understanding of it. Okay, just like if you explain to like your grandmother or something like that how you trade. And you ever sit down with a grandparent and go to them, "Hey, this is how it works. I just do this and I do that, and then we make money." And they're like, "Oh yeah, I get it." That's what computers are like. They're basically they don't really get it, but they can act like they get it. And we're many years away from computers actually getting it. Hell, we're many years away from most people actually getting it. I'm sure you guys know that. You ever try to explain the stuff to like I said, grandparents or parents or girlfriends or things like that? You see their eyes glaze over when you try to explain it sometimes. I see people's eyes glaze over. I'm talking to traders. All right, where were we? Questions, right. Oh, no, we were looking for something to trade, and I see nothing. There's the problem. I see nothing good to trade. I like oil. I think that's I think that the chance of it going higher into tomorrow's close is better than the chance of it going lower. Therefore, I like it. The dollar, as you can see, is pretty toppy here at 97.50. I don't really think it deserves to pull back, but it'll probably technically pull back a little bit. Where will the dollar pull back to? Well, let's take a little bit of a bigger look. What do you guys ask me questions? Where's the dollar going to go? Like here. This is what I do I do this in my head, though. It's a lot easier because when I have to talk, I can't even think of the numbers. But when I do it in my head, it's real simple. So here's the dollar. So first of all, I know 97. 97 is the bottom of the real range. Let's go out further. There's 97. Okay. I've been saying for a very long time, 97 is the bottom range. Why? This is the range we broke over. Here's 97. Here's 97 being tested from the other side. Here's 97 again. I'm sorry, no, it's 97. 97 is in the middle here, right here, in the middle. See how 97 works? Okay, the range of the dollar right now is 97 to 103. That's the range we're in. 97 is the low part of the range. 100 is the middle of the range. 103 is too high. So that's where you can expect to trend. The tendency is going to be to head back towards 100 if all other things are equal. And right now, frankly, our Fed is raising rates. If our Fed is raising rates and nobody else is raising rates, then the dollar should get stronger. That's how it works. So here's the thing then. So having fallen from 103 to 97, now that we know what the range is, we can see what happens. So having fallen from 103 to 97, that's 6 points. Therefore, a bounce is going to be 1.2 points. So 98.20. Oh, and let's see it right there. There it is. 98.20 is a weak bounce. That's our goal. After 98.20, you go up another $1.20. That'll be 99.40, and that's right here basically. 99.40 is a strong bounce. Once we get past the strong bounce, we're back into the bullish end of the chart. That's when you start looking up instead of down. But right now, we're going to be looking at 98, above 20 moves. So 98.20 and 99.40 are your weak and strong bounces. So that's what we're heading for now. So then step 2. So now I know what my range is. Now I say, okay, well, what's the last time we were down here? How long does it take? Well, in November, it took, about a week to bounce. So we had a little bounce, came back to about the same place, and it took about a week to get back to 98.20, to right there, right up there. So that's what we're going to be looking for, something like probably a week of upward movement in the dollar. Doesn't these things, everybody's impatient. Things don't happen. This is not normal. This is normal. Up, grinding up day after day after day. So we had a grind up here, then it pulled back. There's a grind up here, then it pulled back. There's a pretty sharp move up of the sheet. See, now notice the sharp move up, grind ups tend to hold. Sharp moves up don't tend to hold. And why does that look? See, low volume rally. Volume is falling off while you're rallying. Those are always dangerous. All right, this volume is not very good either. Now, overall volume is pretty crappy all the way down. But if the volume's not good on the way down, it means there weren't that many people selling. So you have to compare. Like, look at the volume up. A lot of people were buying. Then people sold. But since then, very, very few people losing interest in selling the dollar. Now, the question is, are we going to get a big volume stick here? And we don't know that yet. It's going to be hourly if it looks like anything. I mean, it looks like something compared to here, but it's not very exciting. All right, so what were we talking about? Your opinion on NQM7. Now I got to be on. Okay, I am not going to get into every single specific contract. Okay, what's my opinion of NQ at 57.80? Let's keep it simple. Can you imagine every? No, not the May contract, the March contract. Like, if your name is Bob and you have the NQM7 and you were born on a Thursday, this is for you. All right, so what was the question now? I lost track of my question. 57.80. I don't know where you got that number from. Is that from our thing? Oh, God knows with the NASDAQ at this point. Ugh. The NASDAQ is in space. Apparently 5,800 is the key spot on the NASDAQ. Well, from 4,000 is easy. It's 5,000, and then 5,000 is 25%, and 6,000 is 50%. So the real line that matters on the NASDAQ is 6,000. Let's see. Get my trusty calculator here. So the line that matters is the NASDAQ 6,000. So where do we consolidate from? When did we really break out? Well, no, this is essentially a run from 4,000 to 6,000. So that means it's been air rejected, but that's still rejected. It's rejected is rejected. It goes to when you're that close and you get rejected, you were rejected by the 6,000 line, whether you touched it or not. Well, so obviously that's a 2,000-point move. Therefore, you're going to have 40-point pullbacks. So your pullback from 6,000, obviously you didn't get there. So that's going to be, wait, am I doing that right? No. It's such a big thing. 2,000 points, you're going to have a 400-point pullback. Sorry. So 5,600 is your significant line. So 5,600 is a weak retrace. 5,200 down here is a strong retrace. Now, assuming the NASDAQ is still in uber bullish mode, then 5,600 should hold on the pullback. If we're going to go to 6,000, then 5,600 should hold. Now, that's clue number one. Okay? 5,600 so far seems to be holding. Get a little closer, zoom in. 5,600 totally holding, air rejections at 5,600. Therefore, the drop, even though we didn't hit it, the drop from 6,000 to 5,600 is 400. That means 5,680 is the weak bounce. and 80 more, 57.60. Right there is the strong bounce. That's what the 5% rule predicts. So the action you're looking for is 56.80 to 57.60. And if you get over 57.60, then we're probably going to make a go for it at 6,000. It's a very bullish indicator then. 57.60, very bullish. Rejected at 57.60, not pleasant. Then we're going to, if we get rejected at 57.60, we're probably going to continue our fall to 5,600. And at that point, anything can happen. But if we get over 56.760, that's bullish, and you're probably going to get a nice move up. So either way, it's going to be a great line to play if we get there. If we get rejected here at 56.80, then we're still falling on our way to 5,600. So if you're rejected at the weak bounce, you're probably going to retest the main line. If you're rejected at the strong bounce, you're probably going to retest the main line. If you're rejected, if you go through the strong bounce, and then you go through the 50% line, which is 5,800, that's a confirmation. But once you're through that 50% line, you have an incredibly good chance of completing your move up. And why is that? It's because the going through those lines indicates there are more buying programs than there are selling programs. The buying programs are in control. And now, because we know the buying programs are in control, we know what their target is. Their target is 6,000. Again, it's just math. If the buying programs are in control, the buying programs have a 6,000 target. The selling programs have a 5,600 target. But if they're not in control, who cares what their target is? They're not humans. They don't trade like that. Once the selling program says, this is not working, therefore, turn off. Selling programs, the way programs work is like it says, if this is happening, then do this. So if this is happening, then sell. You assume they're not shorting programs. See, here's the thing. You have to realize they're not shorting programs. They're programs that are going to trigger selling if something happens. So the program is being told, if this line fails, then sell. The other programs are being told, if this line succeeds, then buy. So they're looking at the same lines as you. The difference is, though, at those lines, that's when programs start kicking in. So you'll see at the weak bounce, there'll be a certain amount of buy programs turn on, and a certain amount of sell programs turn off, and that's how you get the next move up. And then once you get over that strong bounce line, a lot of the sell programs say, well, I have no reason to sell. My program says, if we're below this line, then watch out and start lowering your amount of stock that you're holding. But I'm not below that line, therefore I don't do anything. I just stand here. And then you have the program holding the stock that stands there. Now you have a program that wants more stock that's buying. Therefore prices go up. That's it. Not complicated at all. Especially when it's been years going over it like I did. Bless you. Did I sneeze? Oh, I guess this is. ABX is back to 15 perhaps by something. The dollar, yeah, probably. I mean, any trade here, we just want to wait there. No, our current positions are fine. Again, it's a 2-year trade. I don't know specifically what ABX we have. Oh, where's my portfolio? Oh, there it is. So, for example, in the long-term portfolio, ABX, we have this loose thing with 25 long calls for January. Those are not doing well, actually. Our main position on ABX is we have 50, 13, 20 bull call spreads. So our goal is 20, but our goal is 20 in 18 months. And our bottom is 13, and top is 15, and we sold these puts for $2. So so 13 is really our 13 is break even on the put. So anything above 13 is money for us. So what is there to do? The whole trade's only down about $1,000, so it's just going to sit there. Now, this was a mistake though, because this was a leftover leg from our old trade, and when ABX was higher, we should have gotten out of that position. It wasn't supposed to be held. This position is a double down of that position. Okay, so we bought that position, left this on because we thought it would go higher and we'd be able to get out. And if we look at ABX now, you'll see that we actually blew our opportunity to get out. ABX was significantly higher. Okay, we should have gone out of it. That was a mistake. And now look how much lower we are now from where we were. So we basically blew that money by just not paying attention to the trade. And I'm sure that was my fault. But either way, it still goes to January. I'm not entirely against the position, but it would have been smarter to take it off the table once we established the new position. That's all. Don't let money slip through your fingers. And that's the problem with having too many positions I have. I mean, with all these different portfolios, and this one alone, long-term portfolio, look, these 25, they're just short puts. We don't pay attention to them really. They're not important. I mean, they're important, but they're not going to do anything in general. But we have 7, 3, 10, 31. There's 41 positions here. That's a lot, and that's just one of our portfolios, 41 positions. So, in fact, look at that. We keep losing ground on this thing. It was over 1,400. It was over 1.4 million before. It was 180%. Lost a little bit of ground during the day. Still not bad. Not bad. 180% gain. It's okay. Are these robot programs only attacking indexes and stocks and futures as well? No, they're on everything. Everything. Look, I'm talking about my dad and I used to do this stuff in the 80s and 90s. My dad was a top-notch systems analyst. My father wrote the system that he wrote the Project Head Start national system. He wrote CEDA's national system. He wrote the Office of Aging's national system. He wrote the accounting system for the city of Chicago. This is back in the day when there were no such things. Like, he wrote the first accounting system Chicago ever had. For a computerized accounting system they ever had. So, he invented these programs. It wasn't like they were sitting around like he just made an adaptation or something like that. He was a really top-notch systems analyst. And but he only did government work. He was socialist. Which is why my mom divorced him, actually. I mean, he was one of the best programmers in America, and he didn't want to make any money. He wasn't interested in money. He only wanted to do things that had human benefit. He did okay, but I mean, he could have been very rich if he had gone a different direction. But he was like, I have a talent. I can help people. I can make things better in the world. And that's what he liked to do. So he had the company he set up with his partner only did social service programs because they felt that all these companies like IBM and crap were taking advantage and making fortune when they shouldn't be. And so they would underbid everybody on social service programs. For the shop that they had, they made plenty of money, but it was an interesting business model. But meanwhile, to pay the bills, sometimes we would do these consulting jobs. So he would do the consulting for the banks, and I was basically, and again, they didn't have a huge team. So even though I was just out of college, I was called in to be the interpreter when they would have to sit down and design systems with the banks because these guys, my dad and his partner, didn't really know finance, and I knew enough about computing to speak to them and discuss what they were doing, but not enough to do the programming. But between all of us, we would get something done. And back in those days, nobody had computers. Everybody's like, let's see what these big things can do. That kind of thing. Like, all right, I think we can do this and that with a computer. So these early versions of trading programs are what we worked on. It's not the kind of stuff they have today, but those original designs, there's nothing really has changed. It's just gotten more sophisticated. Just like Windows today isn't that different than Windows from the 80s. It's gotten so much more complex, and it's got so many levels and so many different functions and blah blah blah. But on the whole, it puts Windows on. It puts the screen into Windows so you can see lots of things running at the same time. It's not brain surgery. The other funny thing about programming today is that the programs like Windows are so complicated, and that goes to these trading programs too that they run at these places. They're so complicated that it's generally not one guy. Like it used to be my father would know the entire program backward, forward, and sideways. Now these programs are so sophisticated, it's not like one person who actually knows how the whole thing works. You know, they have a guy who designs it, and then they have guys who work on all the little pieces of it, but there's no one person who has the whole thing in his head like we used to in the old days. You used to have to, you know, you'd have a programmer who knew every single thing, every line of code in the program, they knew it. But anyway, so you know, so the thing is, we did so many jobs and so many banks and so many places and so many trading houses that we wrote these things for. And I did my observation in doing all that was sort of like you know, it was like from high in the air observation where I started thinking about them all in terms of like what everybody was doing as a group and what all of Wall Street was starting to do. And that's when I realized that all they were doing was essentially the same thing in a different flavor. You know, and it wasn't because we were just designing the same thing in different flavors. Those were their specs. Everywhere you go, they all say, oh, we're going to do something completely unique. But, you know, a couple of guys go, oh, wow, that's very clever. But then 2 meetings later, like another guy saying, oh, this is what we're going to do. And we're like, oh, you know, we look at each other and go, yeah, you think you're the only one who figured this out. But anyway, so now these bots trade everything. Remind Windows 10. View your privacy settings. No. So they're not attacking, they're replacing people. You know, the NYMEX doesn't have floor traders anymore. There's just computers. You go to the floor of the NYMEX, there's nobody there. There's no, you know, there are no human traders. And, you know, now those traders are taking orders. They're executing orders from houses. But now when you take a step back to the investment houses, they're using computers to make these decisions. And more now. The thing about a computer, first of all, the best thing about a computer is that you don't get blamed when the computer screws up. That's the best thing about a computer. It's not your fault when the computer doesn't work, unless you're the guy who designed the program. But hardly ever these people are. So you know, if you're a senior partner at Goldman Sachs and they offer to have you use this computer in your department, you're like, oh, absolutely. You now can never be blamed for any problem. Like you're just like, I used the computer. I did what you told me to do. You know, give me my bonus. That's the way it goes from now on. No more decisions. No more like, I let that slip. It's like, no, you don't let anything slip. You're not expected to understand how it works. You know, you ran the computer. It did its thing. The algorithm was bad. They'll have meetings and meetings and meetings about why the algorithm was bad, and they'll tweak it, but it won't affect your job. And believe me, when you land one of those senior positions at these places, most of these guys only care about keeping their job because they probably lucked into the position in the first place. Yeah. A lot of these guys in these trading houses, they luck into their positions. Like they have a good run of trading, and they do really well, and they get promoted, and then it's that Peter principle. They get promoted to the level of their incompetence. They're not really that great. They just happen to luck out on some trade 5 years ago, and everybody started noticing them, and then they got lucky twice in a row, and they got promoted to a senior partner. And but since then, they've been like just grasping at straws, trying to figure out how to keep their position. You know, a lot of these guys are not really brilliant traders. They're just lucky guys who were in the right place at the right time. And so they're terrified of losing those spots. You know, if you get fired, you know, if you leave a firm, that's one thing. But if you get fired from a firm, you have a really hard time getting a job in another place. Because they're always like, well, what the hell is wrong with you? At some point, can we look at a butterfly opportunity? It's been a while. Yeah, you know, it's been a while because first of all, it's been a while because our butterfly portfolio is underperforming. So I'm not going to throw good money after bad. Oh, well, it came back nicely, but and again, it's only up 250%. It's so silly, isn't it? It's underperforming because we have a few trades that we've been trying to work out of. Oh, this Apple trade's crushing it now. That's why. So these are the long calls. The long calls are down $42,000. That is ouchy, huh? But fortunately, we sold short calls, and they're down. They're up 25. So net, we're here 17. Here's 51 on the short calls that we sold, and the rest is profit. So 1751 is $34,000 since 6/6. So the entire turnaround in the butterfly portfolio is this trade. which has made $34,000 in a week. What's today? Yeah, a week. Now again, we were behind. We had a loss on the trade, but that was already eaten. It was eaten by the net of the portfolio. It came out of the cash and whatever. We rolled the position to this. But what matters is, as of the 6th, all these were zero, right? Because they're effectively new positions. So as of the 6th, these were zeroed out, more or less. And since the 6th, we have now gained $34,000. Based on only because Apple pulled back to our target. Our target was 140 calls. We're at 143. Those calls are still 850, but that's pretty good. Oh, by the way, I imagine it probably happened already. 20 of these were supposed to be sold. I'm sorry, not sold. Bought back to $8. I'm pretty sure we hit that target already. So at $8, 20 of these were supposed to be bought back, which turns us more bullish at this point. Because remember, now we go back to the Apple chart, which we were talking about before, and this is the first inflection point. So when I made that call a few days ago, or last week, or whenever it was, when I made that call, that was exactly what I was doing. Was I was calculating the pullback on the 5% rule, and based on here it was $8. So early this morning we should have triggered those buybacks. But when I said let's buy those calls back, 20, 1/3 of the calls, we bought back 1/3 of the calls at $8 because I thought 142 would be the bottom, and therefore looking at the option, all right, probably you might want to know this. So without going through the whole thing, Apple. Without going through the whole thing, those were the September whatever puts. I don't remember when I said it, otherwise I would get find the exact. They're September 140 calls. So at the time they were. Does that even work? No. All right. So at the time they were whatever they were. They were $9.50. They were $10. Whatever. So when Apple first started dropping, I said, "Oh, if we get a chance, I want to buy these guys back for $8." Because I looked at where I thought we'd be. I thought we'd be at 142. I looked at the delta, and I said, well, if we drop to 142, then I expect this thing to hit $8 based on where we were and what the delta was. And that's where I come up with that number. I don't pull them out of my ass. I'm actually using the 5% rule to determine where we're going to make changes in the portfolio in the future. It turned out that one was dead on target because again, that's the expected pullback. This 144 line was the expected pullback, but I of course also expected some kind of an overshoot. So it was this day when we hit 142.50, which is I guess last week. So Friday, well, let's see if we can find that. You also have to know how options behave because, oh, that was right. You also have to know how options behave because the first day down, it didn't really get to where we wanted it to go. Control F $8. Nope. 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 This one I would have done that. Oh, might have been the day before in the morning. Thursday? Not that Thursday. Option second. That's too far back. Now we can move forward. Nope. Don't know when I said it. I know I said it, but I don't know when. But anyway, be that as it may, that's what we need to do is buy those back, 20 of them. One more try. Oh, there it is. All right. So, what were we doing in context? Oh, we were doing the options opportunity portfolio. I was talking about Apple, big adjustment 6-1. September 140 calls it back to 950. So I was complaining because they bounced back. And I said, so there goes 4,500 of our gains. Expect volatility as our long position is a spread and doesn't need that much to protect. If we do get another chance to buy back 20 of the September 140 calls to 8 or less, let's do that. So at the time, when was this? What was the time? This was at 11 o'clock on Monday. So now we can look at the chart and see where that was. So at 11 o'clock on Monday was the 13th, right? So we were back up here. We gapped up here, and that's when I made that comment. I said, oops, there goes so much of our thing. And so I said, if we get back to $8, and that's what I was expecting. I was expecting to come back down to this 142 line, get a chance to buy the calls back to $8 and lighten up, because there is a decent chance that this will be as low as we get for Apple, and it would be a shame to miss an opportunity to buy back the calls for half price, 2 weeks after we sold them. So that's how now. See, all that is how much time and effort I put in to making that little comment. So imagine how long it takes me to do a long-term portfolio review. Because I have to go through that on every single position. I have to go through, well, what about this? What's the delta here? What's the strike here? What are we looking at here? What's it likely to do between here and there? What's going on in the news on this company? That's every single position I have to go over like that. And also I can say, in the end, I go on track. Because even if I say on track, it's after I check everything to make sure it's okay. It's a hard job, guys. I need a robot. I need a robot to replace me as fast as possible. At some point, can we look for another butterfly? All right, so can we look for another butterfly? Let's just survive the ones we have, okay? So at the moment, I'm not that interested. I want the market to calm down. I want it to go back into a normal. This is not a normal range. This is a ridiculously high range. A butterfly portfolio needs stability to function correctly. And by the way, you don't need more positions. If you don't think you're making enough money, I want to say just do more. If you don't think you're hitting your goals on the positions we have, you can always buy more. Take the reliable ones and buy more contracts. In fact, we just did that. Well, we just did with Apple for one thing. Apple was one of our more reliable positions that we felt that we could work on. The calls blew us out, but I felt very strongly it was going to be temporary. Some of them have paid off better than others. You take the more reliable positions and double down on those. There aren't that many positions that you want to play a butterfly on like this, because you need to have, and you're not going to see many examples of that. You have Apple, and look at the. It has to be in a decent channel that you can rely on long term. Apple blew out of its channel on it. We had to roll. With the 140s were already a roll from 130 short call. We thought 130 was the top of the channel. It blew the top of the channel for us. So that didn't work. It worked for a long time, and then it didn't. PG. Okay, we think this is the top of the channel, but we were pretty sure it was going to hold down here. Microsoft completely went off the rails. But the whole market's like this. Okay, Microsoft should have topped out around 60-something, but it didn't. It's up at 72. Now, you say, can we have a new position? Well, if I have a new position, we're going to have the other problem, because we have a new position and we artificially force ourselves to pretend that this is going to be the channel, even though I think it's still overpriced. then what's going to happen? Then if there's a correction, we're going to get blown out that way. And I don't want to be putting out fires everywhere. So, with the butterfly portfolio, the idea is to try to make it stable as possible. It's stable now. It's producing a good income. It rode out a pretty nasty turn against it recently. And it's not terrible. It went down 10% basically, but now it's recovered most of it. So it's not life and death fluctuation, but I don't want to add more to it so I have bigger fluctuations. I'd rather work with the ones I have until they're back to being stable, and then we can look at something to add. But, none of these things are particularly great candidates, unfortunately. Even though these were the ones we chose. Here, General Mills is probably our star, right? That's a good channel. But we already picked that one. That's what you want to see in a butterfly portfolio. You want to see this kind of stability. It goes up and down, but in a pretty predictable channel that you can then play, that we can always sell puts and calls and mostly get our money back. Now, occasionally it's going to blow you out. Then you roll yourself out of trouble, and if it gets back to your channel, you're going to be in good shape. But those other ones we were just looking at did not get back to their channel, and we've been scrambling to fix them. Not terrible. It's not a disaster, but it's a pain in the ass. We missed. We made no progress for like 2 months in the butterfly portfolio because we've been sort of scrambling to just roll things along. Now, fortunately, because we sell the premium, we mitigate the damage from the rolls. So what ends up happening is that, okay, we're still selling premium every month, but now what happened is like this month and last month and the month before maybe, all the premium we sold, instead of becoming profit, which it usually does, just went into covering the damages from the move that went against it. So I'm not looking to add more positions when the ones we have aren't stable. Okay, like we work on the stability of the ones that we have, and you shouldn't want more. It's like how many positions do you want to manage? This is 13 different positions here. No portfolio, no. A regular person. I'm very experienced. I've been doing this for decades and decades. I've got 20,000, 30,000 hours of experience versus 10,000 for what they consider an expert. And like I said, I'm having trouble. I forgot to take out ABX. 60 positions is too many for me to be watching. Or whatever the hell I have, 80, 100, whatever the number is. But now again, a lot of them are repetitive. Like there's very few positions, and by design, because I can't take it. Very few positions in the options opportunity portfolio are not also in the long-term portfolio or the short-term portfolio, and the butterfly portfolio has its own. But let's say in the long-term portfolio, not counting the puts, there's 30-something positions. So I'd say, and then there's 13 here. So I'd say overall, it is 50 or 60 different positions that I'm watching. That's too many. That's too many for a regular person. 20 is the right amount. 40 is a lot. 60 is ridiculous. You shouldn't want to watch more than 20. Okay, you got 20 positions. You spend 3 minutes reading about each one in the morning, and there's 2 hours. There's an hour shot right there. Just spending 3 minutes on each one. If you can't spend an hour every morning reading the news on every position you have too many positions. Assume the butterfly portfolio will continue to underperform until volatility increases. No. Not volatility like the VIX volatility. The butterfly portfolio needs the market to stay in a range. Doesn't need it, but I mean it performs best when the market stays in a range. Because and of course obviously assuming that the stocks that we pick stay in a range also. So it's not about the volatility. In fact, the kind of stocks we look for in the butterfly portfolio are the ones that are short-term volatile. So in other words, they go up and down 5% or so a lot. But long term, they stay in a pretty good channel that you can depend on. Because what are we doing in the butterfly portfolio? We're taking long-term positions that cover the short-term positions we sell. But if we get blown out, the short-term positions will move faster and gain more money than our long-term positions, and we will be underwater. And we could be underwater for quite some time. And we're not going to lose much money because we're covered. That's the whole point of the butterfly portfolio. We are covered, but what we lose is the opportunity to make money like we should be making if things go well. Because that really is the secret to the butterfly portfolio that people don't understand. The butterfly portfolio on the whole, it either makes money or it doesn't make money. Over the long haul, there's a very, very, very small chance that you could lose money because every single position is completely hedged. In a non-aggressive butterfly, the average is a little more aggressive. Sometimes we take chances, but in a regular non-aggressive normal butterfly that we start with, and by the way, we would not take any aggressive stances except that we're doing so well that we get to afford to take some chances. But generally, the point of the butterfly portfolio is that it's not possible to really lose money. It's what you lose, though, if you lose the opportunity to make money this month, this quarter, whatever. It's like, oops, it's a loss for now, but if you roll it out and roll it out and roll it out, by the time you get to 2019, you'll be above the calls that you have. So, in other words, here it is. Okay. So, this is not a good example. Costco, hopefully, is a good example. Nope, Costco is a spread. Damn it. All right, Microsoft. Here we go. Okay. Yes, no, yes. In Microsoft, we bought the 2019 6250 call. We sold the September 6750 calls, right? So even if we get blown out, because the delta on the 6250s is lower than the delta on the 6750s. So even if Microsoft blows us out here, and it is above these calls already, but we take a loss. If this goes to like $12 for some reason, okay, we'll be down $12,000. We'll be down 20 times $6 difference. So we'll be down $12,000. These options will maybe gain $8,000 of it. So we'll be net negative $4,000, okay? The reality, though, is that eventually the premium will wear off of these. We're going to roll these from 67.50 to 70 to 72.50 to 75. So over time, we're just going to keep rolling them a little bit higher, a little bit higher, a little bit higher. And by the time we get to 2019, this will be a 62.50, maybe $75 spread, and it'll be a 12.50 spread. And how much did we pay for? We paid $5.80 for that part. So this could have all the premium in the world, but by that time we'll get called away on here, and these will get called away, and we'll get the net of the spread. So we won't lose, but the problem is we also that whole time that we're rolling for a year and a half, we won't be making any money. No money will be dropping into our cash pile, which is where we want the money to be. We want the money to be here, not tied up in the position. But it's so hard to actually lose money because of the nature of the way we set up these spreads. It's just a question of losing the time and losing that monthly or quarterly opportunity to make more cash. That's the part we like best. We love that we have $300,000 in cash in a portfolio that started, when did it start? It started in 2013 in July with $100,000. So 4 years ago, it started with $100,000 in cash. Now we have $300,000 in cash and a $350,000 value. That's the kind that this is a retirement-style portfolio. It should not be volatile. It should not be painful. It should not do anything too weird. And it's doing exactly what it's supposed to do. It's supposed to make 40% a year, and that's right about where we are. 40% a year compounded, of course, is here. I don't know why you would want to, again, why are you adding positions to a portfolio that makes 40% a year or netting 60% a year the way it's coming in? This thing is netting 60% a year to divide the total gains by 4 years. It's doing exactly what it's supposed to do. It's adding positions doesn't make it better. It just makes it more volatile when it goes the wrong way. All right. So what time is it? Oh, 2:40 already. And butterflies continue to pull, right? Okay. What is a good number for a new person manager? You mean positions? I mean, really, there's in our educational section somewhere, I don't know where, the wiki isn't working. The wiki's broken. Until we get the new WordPress, we can't get the wiki fixed, so it's really annoying. Somewhere in the educational section, in the archives, educational archive. Hello? Okay. If you keep going back in the educational archives, I believe there's probably 3 articles on smart portfolio management. And it talks about setting up a $100,000 portfolio, I think it talks about 25,000 too. I think it's 25,000, 100,000, and $1 million. And in all those, we talk about the size and the number and so on and so forth. But the quickest way to answer that particular question is, look, if you have $100,000, it's unrealistic to have 20 positions of $5,000 each allocation, in which case your allocation blocks are 1/4 of an allocation unit. So when you start, your initial play should be 1/4 of what you're allocated. So you'd be at $1,250, which means the most you could spend on any play is $1,250. That's very limited. It limits the kind of stocks you can play. It limits the kind of options you can play. There's a lot of limits. In that case, if you have $100,000 or less, you probably want to set your allocation block to 10% of your portfolio. Okay. Also, I'm sorry. At $100,000, you really shouldn't be using a lot of margin either. That's why I was saying it should be a 5,000 allocation block. So, $100,000 portfolio, you really want to have 10 allocation blocks of $10,000 and break those down into $2,500 units to start with. That at least lets you buy 100 of a $25 stock. But below that, I mean, basically, this is another thing people make a mistake all the time. If you have a $100,000 portfolio, that is your allocation limit. It's 20. You should have a 20. You can't buy a stock that costs more than $25. It blows your allocation. I know it sucks. It's very tedious to build a portfolio when they're small, but it's still money. And that's what you have to do. You have to look at it realistically and be like, over time, the best, safest way to grow your portfolio is to allocate your blocks properly, manage your money properly, and that means starting off very small. When you have $100,000, your goal should be to make $20,000 in a year. Just because you only have $100,000 doesn't mean you should try to make $200,000. That just increases the chances you'll lose your 100. You're really only going to make about 20. That's realistic. You make 30, 40, that's fantastic, but you shouldn't even try for that. It's just if you happen to have good luck, you make 30 or 40. But you should be aiming for 20. Good, sensible, small trades that make a little bit of money at a time. But basically, position-wise, 20 positions, I really wouldn't go over 20. Because like I said, if you spend 3 minutes, you go to Yahoo Finance in the morning, or something else. I happen to like Yahoo for that kind of stuff. Actually, I don't like it as much as I used to because they just made it very annoying. But besides that, anyway, so you go to Yahoo, you punch in your portfolio, you say, here's Apple, and now you say, okay, what happened today that I didn't read yet? Surface Pro, machine, technology. Apple's a pain because it has a lot of things happening also. Automotive, iPhone, upgrade interest running high. So, you got to read your articles and be like, and I'm not saying just look at them, I'm saying like read these things when they're relevant. And you have to say reasons to be worried about Amazon, don't care. New look at iPads, maybe you care about that because that's important to them. Outlook points to strong Apple iPhone 8 sales cycle. So, you want to read what's going on with your stock. And you've got to do that 20 times. And if you don't have time to do that in the morning before you go to work or before you leave, so you can make a decision in case something's going wrong, you shouldn't be trading it. That's the bottom line. I mean, I can have 60 open positions because, first of all, I've got 500 people watching them, So people, if something goes on, somebody usually says something. Second of all, I'm doing this all day long. I'm not just doing it for an hour in the morning before I go to work. I'm doing this all day. I'm here all day long. So that's all I have to do all day to look at positions. Even so, though, if it was my personal portfolio, I would cut it back to 20. If it was just me running my own portfolio and trying to have some kind of life, I would not have more than 20 positions. It's too much. It just has to be too much of a pain in the ass. And I'm not counting short puts. Those short puts, as long as you know how to cover them properly in case something goes wrong, you can have your on-deck positions basically almost as many as you have regular positions. Sometimes I have 20 active positions and I have 20 short puts. That's fine as long as those short puts are not in any danger and you have a hedge that covers them in case something bad happens. But then the short puts, as I was talking about this morning in our long-term portfolio review, those short puts are a really great money maker. And it's a funny thing because, we had a $500,000 long-term portfolio started in 2013 as well, I think. Now we have 24, 25 short put positions. Those short put positions are going to throw off like $90,000 over the next 18 months. Just the short put. So if the market keeps going up, we got $90,000 coming to us because all those puts will expire in the money. So between that and the dividends, we're getting $100,000 a year. And the whole portfolio was only $500,000 when it started. So I'm getting 20% back just from dividends and short put sales. Then I try to make money on my positions. But my base is 20% return. That's the way you run a portfolio. And then what does that mean then? If I know I have a 20%, if I know I have a 20% base, it means I can take 10% of my money, $100,000 a year, I can take and spend it on hedges. Because that way I'm still going to make 10%. If the market doesn't go down, I'm going to make my 10%. Taking half of my 20% that I know I'm going to get in a flat or up market, and I'm taking half of that money. And these are not the bets. These are just the short puts, which will expire worthless in an up market, and the dividends that are going to come no matter what. I'm taking half of that money and using it to hedge. And if I get a 5-to-1 hedge, I can have a $500,000 hedge, and I'm still making a guaranteed 10%, and all my positions are basically covered. And that's the way you run the portfolio. You shouldn't make it hard on yourself. You should make it easy on yourself. Every move you do should be to make it easier and safer, not the other way around. What are we trading during the webinar? We're not trading during the webinar because, frankly, everything is too weird to trade. So there are no particularly down. The index is dropping back up. But oil's bad. Gasoline, not so great. This I sold, so I might want to jump back in that. This would have been a good long, but we missed it. The dollar, as I said, I think it's pausing here. Gold. I like silver if you're dying for a trade. Oh, coffee. Coffee at 128. KCU7 coffee, 128. I like it long. At 130, I take the money and run. It's a lot of money on these coffee contracts. Silver at 1675. I like it over the 1675 line. At 17, I would consider taking the money off the table to get a nice run. That's $50 a penny. So what's 1,000? Like 1250 if you get to 17. 1725 would be $2,500. So those trades I like. All right, I already have coffee. I don't have the silver. I'm not really looking to buy it now. So I would buy. See, I don't want to buy anything because I'm working on this one. Once the oil pays me off, then I'm happy to go to another position. But that's, by the way, that's another thing. When I have a losing position, I work the position until it's a winner. So I'm going to keep. I'm working on oil right now. Gasoline, I was thrilled I got out of it and I got my money back. Oil has not yet given me a pop. Maybe it never will. All right, maybe I'm going to abandon it and take the loss. But at the moment, I'm still hoping it kind of recovers a bit. But so my top plays are coffee, and silver for the long. So silver at 1675, tight stop below. Coffee 128, tight stop below. Those are my two favorites right now. And as far as a trade, no, I do not have a trade. I don't have any specific stocks that I'm dying to get. Oh, there was EWZ though. How's EWZ doing? It was in a post earlier this week, and I never put it in the curve. I forgot to officially make it for the OOP. I forgot to tell the OOP people to do it. Damn it! All right. So there was an EWZ trade. I'm good on that. I like them down here. Not a huge pullback, but it's because of the scandals, corruption, all this nonsense. But it's going to blow back over. I mean, they'll get rid of the guy. Whatever happens, doesn't matter. Brazil, the economy is still rebounding, and you're going to see this thing come back. So I like EWZ as a bullish play. I think it might have been in Monday's post. Don't know. Let me see. Was it? No, don't know. That was waiting on the Fed. No, I don't know. At some point, I had an EWZ play. If anybody knows, let me know. Once you have an option, once you have a portfolio built, how often do you review? Oh, and by the way, Emad, this is an important point. I think, and I told my brother about it. My brother just came in fourth in a big poker tournament. I spent years teaching how to be a better player too. It's like he's getting pretty good. We were talking about strategies though, because that's what came up. And I was saying it's very much like stocks. And I said I said this to him. I said, here's the thing. I like playing cash games because I don't have the patience to sit for a tournament. I sit on my ass here talking to you guys all week. Not it's the webinar, but I'm always sitting down just doing the chat room and stuff. So I'm basically sitting on my ass 40 hours a week. I do not. And it's a lot more than 40 hours. I'm writing in the morning too. So I'm not in the mood to spend 16 hours on the weekend playing a poker tournament. I'd much prefer cash games so you can sit down for an hour or two, win some money, and leave. When I go to the casino, I like to play, and plus I like to do stuff. I don't like to just sit there and play poker all day. That to me is starting to get to be a problem. But this is what I was saying to my brother. This is a problem that people who play the markets have. Is the same problem people who play poker have when they play cash games when they come in and out, is that you don't let the bargain come to you. You don't let the trade come to you. People tend to sit down at 12 o'clock on Tuesday and say, oh, I've got an hour to trade. And then they sit there and they force a trade. Okay, so like right now we're having a webinar. There's no good trade. There's nothing really particularly jumping out at me to play. Nor was there today in chat. I don't think they had any trades today in chat. It's a weird market. We're just coming off the Fed. We're not really going to have a handle on what's going on until this week resolves itself and into next week. There's no particularly great play that I see that's a definite one. Yesterday there was. Yesterday the dollar long was an obvious thing to me after the Fed. It was like here yesterday I was banging the table on this trade. So I said the dollar should no way be down that low based on what the Fed said. That was easy. But it came. I sit here all day, and that happened to be the right time, and I called it. But to say right now, okay, now's the webinar, therefore we have to trade, that's a bad attitude because you then find the best of a bad bunch. And that's the same with poker people. That was my point with my brother. I'm saying you have to realize some guys, if you want to find a sucker at a poker game, you look for the guys who sit down and they're looking at their watch and they probably have to meet their wife for dinner or something like that. And those guys are not going to wait for good cards. Those guys are going to play something that's decent that comes. Anything decent that comes, they want to play a hand. Because they sat down and they want to play a hand. And whether it's a good hand or not a good hand, they're probably not going to play a crap hand, but they're going to play a hand that may not be something you'd play if you had a choice. Because you've got to have that mindset that I'm here for 4 hours, or your mindset has to be, I'm happy to walk away without having played a hand. I'll sit here for an hour, and if I don't get any good cards, then I don't play a hand for an hour. That's all. You can't say, I have an hour to play, therefore I'm going to damn well play some hands. That's how you lose. And it's the same thing with the stock market. You cannot sit down at a trading desk and say, it's my time to trade, I have to trade. And this happens on Wall Street all the time, and I coach people on this, and it's a problem professional traders make as well, because they say, oh, it's bonus time, I've got to impress my boss. Oh, it's like, the junior traders are the worst ones because they're like, oh my God, I got to see the desk, I got to make a trade. They're finally given a little bit of authority, they get an account, they get some cash, and they go, oh, I got to do something now, I got to justify why I'm here. No. You get paid when you make money. You don't get paid just because you found a trade. And if you don't see one that's obvious, it's really absolutely going to make you money, don't trade it. And it's hard. It's so hard to learn to be patient, and it's so hard to have that discipline to look at things and say, no, not for me, not today. But you have to. That's the most significant improvement you can make to your trading is learning to say no. You missed it. All right. In other words, like this, the dollar went zooming up, and it goes here, and you say, well, is it going to go up? I'm like, it'll probably go up, but I wouldn't play it anymore because I don't know that it's going to keep going up. It's no longer easy money. This was easy money. This was me going yesterday. I was like, buy that. Because it was ridiculous. It was stupid. Everything that was happening told me this was wrong. That was easy money. But once it goes here, I don't have that conviction anymore. So I wouldn't call it. Unfortunately, people keep asking, though. Or here. Okay? Yesterday, I was banging the table on natural gas at $3. It went below $3. I don't care if it's below $3. This is where I like buying it, down here. It was at 2.95. It's only 2.95 here. It's not that far below. Now it's 3.08. So we went, where are we? Here's the $3 line. It went lower, and I bought more when it went lower because I'm like, I'm thrilled. I don't care how low it goes. I'm going to keep buying it down here. And we had a great day today, and I think it was, $6,000 or something like that, right? What are we at on NG? Yeah, $6,000 for the day. But that's conviction. Here, somebody asked me before, I'm like, I don't know where it's going to go from here. It might go up, it might go down. I don't care. I'm out. I got my $6,000. If it goes low, then I'll buy it. But not at noon tomorrow will I buy something. I don't know what I'm going to buy. I have to look at everything before I make a decision. And you all got to learn how to do that. You all got to learn to say, look at it, and if there's nothing going on, go do something else. If there's nothing obvious jumping out at you, go do something else. Don't trade. Don't trade just because you sat your ass in a desk at a completely random time in the universe. That makes no sense. You trade when there's a good trade to make. Well, that's a good way to end the webinar. That's real important advice. All right. Once you have a portfolio, how often do you review, assuming you're using being the house strategy? Like I said, you got to read the news on your stocks every day in case something happens. Okay? Usually nothing happens that makes you change your position. Right? So assuming that's fine. Then meanwhile, we generally, as far as a full review, what I do with my members and everything like that, roughly once a month, we will do a portfolio review for each of our portfolios. Usually the week of expiration or the week just before, or like the later part of the week before. So in other words, last Thursday, Friday, I wrote up a couple of reviews. Monday, I wrote up a review, and today I started the long-term portfolio review. But honestly, in the long-term portfolio, there's not really any changes. We made like 3 changes in the long-term portfolio out of all these positions, because mostly we take quarterly positions. We're not day traders; we're long-term fundamental traders. So there's very little that's going to make us change our position. More to the point, we have the short-term portfolio, which is quite small. The short-term portfolio is first of all, it's almost all cash. I'm sorry, it's not almost all cash. It's more cash than there is position. $400,000 in cash. No, $490,000 in cash. $420,000 value. So we have $70,000 more cash than the portfolio is worth. The positions we have a negative 70. Why? Because they're hedges. They lose money in a good market. This is a good market. They're losing money. That's what we're supposed to do. This is where we keep our hedges for the long-term portfolio. Okay? It's an accident that this thing's up that much. In a normal market, we happen to have some really good timing a few times over the years. This is also 3 years old, same as the long-term portfolio. In a normal market, this portfolio would be just minus 70, while the long-term portfolio is up like 300. That's the ratio generally. So in other words, in general, this portfolio should be losing about a third of what the long-term portfolio gains. What happened, though, is because in some of the major market dips in the last few years, we've cashed out the short-term portfolio. When it makes a ton of money on the hedges, we've cashed the hedges, taking a chance that we hit the bottom. And so far, because the market just keeps going up and up and up, every time we've taken a chance, we've been successful. So what does that mean? That means the $100,000 insurance that we collect on a dip in the short-term portfolio turns into cash, and then the market goes back up, and then we cash them. That means we're unprotected, though, when we cash the short-term portfolio. Then the market goes back up. We start buying short positions again. Then the market dips. We cash in our short-term positions. We take a risk at this point. Then the market goes back up. It's not crazy because the cash that we have becomes a hedge, and then, of course, we can always add hedges again if we're wrong and the market falls below the support that we think we're at. We haven't been wrong yet. So we have this ridiculous 320% gain in the short-term portfolio. That makes no sense. You're not supposed to be winning in the short-term portfolio when you're winning in the long-term portfolio. But just very, very lucky timing over the last few years has made us quite a lot of money. But the point is, this is correct. $70,000 loss in our positions versus probably about a $400,000 gain in the long-term portfolio this year. That's exactly what should be happening. These are our insurance plays. So, you have to have that balance. And if you're balanced, you don't really need to check your portfolio very often, but you need to check. Whenever there is a significant market move, you want to just make sure your balance is working out. Like last week, for example, when we had that 2.5% drop in the market all of a sudden, it turned out that the short-term portfolio made money faster than the long-term portfolio was losing it. So we were actually having a positive experience on the dip, which is great. Now, that means we're incredibly well balanced because what happens is when the market goes down, we make more money and then we lose on the long-term portfolio. But when the market goes up, the long-term portfolio makes more than the short-term portfolio loses. So we're winning basically no matter what. Now, why is that? Because we're being the house, because we're selling premium. And so no matter what happens, half of the guys we sell to get burned. That gives us an incredible house advantage, incredible in almost any kind of condition. All right, that's a good way to take it. Taking notes, how to beat Philip Poker. I shouldn't give away my poker secret, should I? All right, guys. Thank you very much for coming, and I hope that was good. It was more of an advisory sort of session, but good to have those once in a while. And I will see you all next week, all right? Thanks. Regular Wednesday next week. All right, take care.